Welcome to today's market report.
Wall Street's major indices closed lower on Friday, while U.S. Treasury prices climbed as investors' fears about the prospects for a global recession intensified, while they also prepared for a massive U.S. interest rate hike from the Federal Reserve. Economic fears were amped up by a FedEx Corp revelation late on Thursday that a global demand slowdown had accelerated at the end of August and was on pace to worsen in the November quarter, prompting the delivery company to withdraw its financial forecasts. The warning came at a time when investors were already jittery ahead of a Fed meeting, after which the central bank is widely expected to raise rates by 75 basis points. Some traders are betting on a 100 basis points increase, according to CME. The Bank of Japan and Bank of England are also due to meet next week. Today is a continuation of what we've seen this week, the volatility around expectations for what the Federal Reserve may do with 75 basis points baked in and 100 basis points possibility. Then you have the dismal report out of FedEx, which some people consider a bellwether not only for consumer spending but also for the broad economy. The stock market is down on a growing concern that's really starting to escalate, that the Fed is going to make a mistake and over tightening. Treasury yields retreated after the FedEx warning revived the notion that slower growth will help the Federal Reserve tame inflation, after increasing to 3.924%, its highest level since 2007. Earlier in the day, the 2-year US Treasury yield, a bellwether for interest rate expectations, fell. The yield curve inversion between the 2-year and the 10-year notes, seen as a recession harbinger, widened further before returning to Thursday's closing level. The Dow Jones fell 0.45%, the S&P dropped 0.72%, the Nasdaq lost 0.9%. The Pan-European Stock 600 index had lost 1.58%, and MSCI's gauge of stocks across the globe shed 0.96%. The Eurodollar climbed back to 1.0008. Sterling was at 114.20.
This is today's market news. Thanks for listening. We'll see you next time.